Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.
This week on Wall Street Wrap-Up, October's job numbers were released today, and we increased payrolls by 261,000 jobs last month. And the Federal Reserve this week raised central banks' interest rates another 0.75%, raising mortgage rates and credit cards to try to put the brakes on inflation. Hi, I'm Andre Laborde. We've got these stories and more. It's Friday, and that means it's time for Wall Street Wrap-Up. Hi, I'm Andre Laborde. Welcome to Wall Street Wrap-Up on this Friday, November the 4th. I hope your week went well. Well, coming up tonight, we're going to be talking about options trading with the CEO and founder of DTI Trading, Tom Busby. How can you command a larger position of stock or of the market with investing in options? We're going to find out because we're going to be talking with Tom Busby. He's going to be coming up. But today, the Bureau of Labor Statistics came out with October's jobs report. Now, last month, we picked up 261,000 jobs for the unemployment rate rising to 3.7%. The average hourly earnings rose 0.4%. But next week, we're going to be getting the CPI, which is the October inflation rate for last month. So we're going to see if the hourly wages kept up with inflation. Well, this week, the Federal Reserve did what we all thought they would do and raise interest rates another 0.75%. Now, this is the fourth rate hike of 75 basis points for the year, and now the total interest rate rises to 4%. Now, there'll be one more time that the Fed is going to meet in December, and the market is already pricing in another rate hike at 0.5%. Now, the big question is, how far into the future of 2023 will they continue to keep raising rates? After the Federal Reserve met and announced their rate hike, the press conference with Jay Powell, the chairman, turned hawkish when he said, and I quote, "It's very premature to think about or talk about the pausing of interest rates." And the moment he made that statement, well, that sent the stock market in a downward spiral, sending all the indexes moving over 1,000 points throughout the day, and the market ending lower for that day of Wednesday. Well, how did the market finally do this week? Well, the markets all ended down for the week. The NASDAQ had their worst week since January. Technology had its worst week since March of 2020. And energy stocks were biggest winners of the week. The Dow Jones ended the week at 32,404, which was down almost 1.4% for the week. And the S&P 500, they ended the day at 3770, which was down almost 3.4%. And the NASDAQ, they ended at 10,475, down almost 5.75%. Well, have you ever thought about investing in options? Now, this is not holding the actual shares of companies, but the option to purchase or sell a larger block of stock at a certain specified time and price. Well, Tom Busby is the CEO of DTI Trading, and best of all, he's here with us tonight. Hi, Tom. Welcome to Wall Street Wrap-Up.
Oh, it's great to be here. Thank you.
A lot of times on our show, we talk about stock investing or other types of investing, too. When it comes to options investing, what's an option as compared to stock investing?
Well, an option, the way I think about it, it's a derivative of the stock, the underlying. And there's really only about 6 actions you can take in the market. And, they are, you can buy a call and you want the market to go up. You can buy stock, you want it to go up to make money. Or you can sell puts to make money if you do that. The opposite of that, the other 3 actions are pretty simple. You can sell stock, or a lot of people call it shorting stock, or you can buy puts, or you can sell calls. If you break it down, 3 up, 3 down, it sort of helps you, I think, grasp the concept of the direction you want to make. And then you put the combinations together, and then they got fancy names for them. I learned it without the fancy names. I'll tell you, folks, knowing what happens when you put your money at risk is the key part of the transaction.
You can command a larger percentage of stock because, like a contract in options, it's considered as a contract, and one contract is 100 shares of stock.
That's correct. Yeah.
Now, when
it's less money to control the stock, and it's based off the movement of the underlying stock. So you got to know how that particular option you're buying or selling moves in relation to the underlying stock.
When you own a stock, you can own it for a day, a week, a month, a year, 10 years. But when it comes to an option, you have a limited amount of time to be able to use or exercise that option, correct?
Right. It's called the expiration date. Okay. And so if you hold it to the expiration date, that's the limited amount of time you have, but there's no reason you have to do that. You can sell it 1 minute after you buy it or hold it all the way to the expiration date. But once it expires, that option goes away. And if you're long that option, if you're long it, okay, then your right that came with that option goes away.
So if you own an option and there's an expiration date, let's say, and I'll give you an example, let's say it's going to be expiring next Friday. Okay, so you can go ahead and get out of the option before Friday. And also, let's say if the option is not working the way you want it to, you can, let's say, roll it over or kick the can down the road to the following adjusted period.
Yeah, you could do that, or you can tweak your strategy. For example, if you're long a call option and your timing's off, then what you could do is maybe turn it into a debit spread, which you sell a strike at a higher price. And there's a lot of different strategies you can do. But to keep it simple, you got the choice of doing a lot. You got just as much flexibility with stock. The great thing about options, you get the leverage. And if you know what you're doing, which is something that you have a process in your approach of entry, approach of watching it, and approach of exiting, then I think you're going to find that the discipline of options is really superior to owning actual stock. You get a lot more bang for your buck.
There are more and more people, Tom, that are getting involved in options today than probably at ever before. How did you get involved in options?
Well, what happened was I was the guy, I was in the Air Force, and when I came back to the States, I had a very good broker that was sort of an educational type broker, and he said, hey, you like risk, because I was flying, and I said, yeah, I like risk. He said, but I don't like to take risks unless I get a reward for it. And he said, let me teach you about options. And the first option I bought was Bally Manufacturing. It was a stock option I paid about $3 for. And the next hour and a half, it went to $7.50. I said, oh, I like these options. And so I've been hooked ever since.
You know, when you go from $3 or $3.50 to $7, a 100% return in a short period of time, it certainly catches your interest. Right now, it's Friday, okay? And earlier this week, the JOLTS number came out. Now, JOLT is an acronym, which is job opening and labor. And the Federal Reserve this week also brought up raised the interest rate 0.75%, 75 basis points. Now, so there's a lot of news that occurs. Do you ever use the news of what's happening to be able to establish what type of options you should or you use, or to get out of something if you're already in a position?
Let's take an example of what happened with the Fed. The Fed had a script, and the script was, hey, we're going to pause or get the market thinking they're going to pause. And then Jay Powell got asked a question. And, you know, he is known as the guy that doesn't know what inflation is, right? Transitory.
It's transitory, right.
Yeah, it's transitory. Everything's transitory, and he hates it. And so some reporter asked a question about that. Well, he went off script. Market was rallying. Everything was blue sky, looking good. And then they asked him that question. He went off script. He said, no, we're not changing what we're doing. We're going to still raise rates until this inflation is gone. As soon as he said those words, the market said, oh, he's off his script. Everything they had told people, the markets don't like surprises or uncertainty, and it went way down.
When you own an option, and let's say, and I'll bring up a date. Let's say your expiration date is next Friday. Well, because we're already Friday right now, but let's say next Friday. How long do you wait until you figure, you know what, I better either kick the can down the road and do a roll, which is for our viewers is rolling it over, or do I get out of it right now, or just let it see if whether or not it will expire with, in your way, would be in the money, which is money in your pocket. What, do you have like a baseline or a guideline?
So I got a simple rule. The simple rule is I use time. I stay in an option, and I usually give it 72 hours from the time I put it on. And if I'm not making money in that option, I usually just pitch it. I don't roll it. I don't do anything fancy with it. I say goodbye and move on, because what happens is there's a lot of energy wasted when people get into an option. They don't take their loss, and they always take their gains too soon. And so the big issue I found in my own trading was getting married to these options and riding into the grave. So 72 hours is a good rule that works. If you're right on an option, you should be making money within 72 hours, or you ought to learn the proper way to time those options, and that could be taught, but you got to have a proper coach to be able to do that.
So let's say, and correct me if I'm wrong, that the expiration dates of options are on Fridays. So like, let's say if it's a Monday and Friday is more than 72 hours, even though your expiration date may be Friday, if you're looking at by Wednesday or so, if you're not up the way you want it to be or down, you make that correction change within that 72-hour period?
Yeah, because what I found is that there's a lot better options with more time. The key to long options is having time. The key to short options is cutting that time down. And so what I have found, if you'll use that 72-hour rule, you'll find out you'll do a lot better, because all the good ones that you stay with are going to be making you money, and all the bad ones are going to be out of your portfolio. And then you do the math on that. Now, entering options is also very important. Let's say that you're going to enter options and you got a certain dollar amount, you're going to go into those options. The way I enter options is I will do it either in thirds, 1, 2, 3, or I'll do it in halves, 1 and then a full boat. And so the full boat never happens for me until I'm making money on the first boat. And so I've developed techniques that allow people to win.
Now, Tom, when you say like a full boat, and I'm just trying to get it correct in my head, so you've got what's known as a strike. So let's say you have a strike, and I'm just going to make it up, let's say a $100 strike. When you say a boat, do you do like, if it's trading in $5 increments, you do a 100, then a 105, then a 110? Is that what you mean?
No, let me take you back, okay? So you got a $100 strike price.
Okay.
First thing you got to decide as an option trader, how much money you're going to put on each bet that you make. Mm-hmm. Is it $1,000? Is it $5,000? Or is it $10,000? Okay, let's say it's $10,000 that you're going to put into that option. So I would put $5,000 into that option by dividing the price into the dollars I'm going to outlay. Okay, so I do that, and so having the full 10,000 there is what I call a full boat. Okay. And the first one is called what I call a probe. Jesse Livermore, go research him. Mm-hmm. He used a probing technique to find the path of least resistance. And I thought it was brilliant when I read it for the first time over 30 years ago. I said, hey, this is a pretty good technique, and that's what I did.
Where some people will say you made a position, some people may have, would say, well, I'm going to have many different positions, but small amount of contracts in each position. What you're saying is you're going to continue with that same position, but add more contracts as you see it's going your way or it's not going your way.
Right.
Okay.
Yeah, exactly. That's the way I would do it. Okay. And see, I made the mistake 90% of people trading options made. I used to do it by contracts. It works out a lot better because you never know when you do an option. I've been doing this for a long time. I never know if this is going to be a winning option until I see it trade. And the mistake I used to make, I'd be all in every time. 10 contracts, 20 contracts, 30 contracts on this one, 5 contracts on that one. So I balanced it out where I got an equal dollar amount on my full boats. And so I get paid the same percentages regardless of the option I chose or how to do it by using that strategy.
How do you know what to buy, what to sell?
Well, we have a software we developed many years ago. It's a proprietary software that runs scanners and identifies the best candidates according to, things like, is this stock up for the year? Is this stock up for the month? Is this stock up for the week? Is this stock higher than Monday's high, Monday's low? If it is, the odds are that stock's going to continue in the pathway it's going. And our software will generate the candidates, and then we'll look at those candidates inside our software to see exactly where they are. We have buy zones and sell zones for each of those underlying stocks. So we put a lot of effort, a lot of money in trying to figure out how to get the right horses to ride. In fact, we have a demonstration deal that we do. It's pretty funny, called the horse race, where we put our stocks in there and let them race against each other. And the one that wins is usually the one we go with.
There's a hedge fund, and it's called Medallion. It's run by Jamie Simon, he's a mathematician, and he has an algorithm and unfortunately, Medallion is a closed fund, so none of us can get into it, but they have been bringing in returns of many times 50% a year because of these mathematical algorithms. Is that sort of like what you've got with the algorithm that you've put the numbers in? Mm-hmm.
Yeah, sort of. We have algorithms behind our decisions, and then we have just common sense behind our decisions, okay? Because no matter what you do, there's two things that the markets function off of: greed and fear, okay? Mm-hmm. And so you have to measure that, and we have ways of measuring that. But the whole approach is having that process in place before you bring the emotions into it. Most people, it's really funny, and I know this from my Air Force days. If people are really time sensitive and task saturated, they're going to make a bad decision. But if they think it out and have a good plan, they usually make better decisions. But I can tell you this: options are probably one of the best areas of the market to learn about, and you continually learn. I mean, it never stops. There's nothing set other than the fact that you got your approach, you got your process. And then the other factor that enters in that a lot of people don't account for is the amount of time they have to do this. You can't do an option and all of a sudden go off for 3 or 4 days and figure out you got this option whether you made money or not. You got to have a plan with that option if you go off 3 or 4 days. And I'm not saying being glued to a screen, which I was for so many years, and I think it's crazy, but I learned not to be glued to that screen.
If you're just joining us right now, we're happy to have the CEO of DTI Trading, Tom Busby. We've got a lot more. Don't go away. We're talking with the CEO of DTI Trading, Tom Busby. Tom, a little bit earlier, we were talking about the Federal Reserve, and this week, Jay Powell came out with a 75 basis point interest rate increase. Well, right after that, he had his press conference that he always does every month when he has a meeting. Did anything what he talked about? What did that tell you about the Federal Reserve?
Well, the first thing you learn, I've been doing the Fed for probably 20 years. And when I say doing the Fed, I trade it live in front of people. Mm-hmm. And the first thing you learn is watch the market. And really, you can read the transcript later, but the market will reflect how they're receiving the information. And here's what happened on Wednesday. What happened was he was following a script. And by following that script, the market started rallying. He's doing exactly what he's supposed to do. And then he got off script, and the market started turning down. In fact, it turned down so severe, we went below where we were trading, and it closed at the low of the day, which means I'm sure on Wednesday night, I'd like to hear the backstory on this, but I bet on Wednesday night he was getting some calls about getting off script.
You hold options for basically about 72 hours before you make a move. There would have been no way. So this was on Wednesday when he had his press conference. On Tuesday, there would have been no way knowing, or even Wednesday morning, there would not have been any way knowing he was going to get off script. And as you said, you were watching the market. In the event of, say, like Wednesday, when he got off script and you saw the market starting to go down and down and down, how did you, or what would you do to play that?
I'll tell you exactly what I did. I bought puts, because puts, you make money if the market goes down, and it went down that last hour. And people started selling. It was just a classic case of they had a reversal intraday, and I happened to be there, and it was it was a very nice afternoon for me and people that listen to me. But people that don't look at those finer points of the market are probably looking at their account, from Wednesday to today, and thinking, "Whoa, look at that drop." It was a pretty severe drop in a short period of time.
Tom, we talk about emotions. In fact, right before going into a break, we talked about the emotions. And trying to take emotions out of something is trying to squeeze blood out of a rock or something. I mean, how do you trade without using the emotional part in it?
All right, I want everybody that's listening to write the following down. Mm-hmm. Make your decisions, not how you feel, but do it based on numbers. Follow the numbers. Let me give you an example. This year, the market has been down probably 20, 25% across the board. Everybody said, this is a good buy. This is a good buy. No, it wasn't a good buy. Here's the problem. The problem is the numbers said it was going lower, so you should have been playing to the downside. The only market out of all the markets I follow that's been positive this year has been the energy market. And the energy market has maintained that trend except for about a 2 or 3 month correction, but it never corrected below where it started the year. So therefore, it was a great buy. And now, in the past, 10 days, it's up about 10, 12%, probably going higher because of that trend that's been created. And follow the numbers is the best way to override the commercial. Like, for example, if I get in a stock and I start losing money, mm-hmm. I look at my numbers that tell me, where was I before I made the trade? Where was I wrong on this trade? That's called the all bets off number. If I see that, it's like an umpire in a game. You're out of here. I go on to something better. That's the only way I've ever been able to beat the emotions, because it is very emotionally to see your account go up and down the way you sometimes see it happen with the drastic movement that you have in the markets.
What's the most common mistake or mistakes, I'll say, one or two, the most common that you find most investors make?
It's pretty simple. Most people made their money doing something else. They were very good at making their money. Mm-hmm. And the most common mistake I see is they don't have a process to take their money and take it from their bank account into the market. And that process has to be, let's look at a stock. Where do you think it's going? Is it trending? Is it not trending? Where am I wrong if I think it's going? Where am I right if I think it's going in the direction I think it's going? All this should be done before you ever put a dollar at risk, which is called having a plan. And then you review that plan over and over again until you get it perfected for yourself, because everybody's different. That's a common mistake. People, they come in, I call them the cowboys and the cowgirls. They made all this money doing other things, and they get in here and lose it because they don't have a good plan. The second most common mistake is how they feel. Emotions play a terrific part of somebody's ability to make money. And they have a process they're going to do. And then all of a sudden, they don't feel like taking the trade because they just don't feel like it. You got to get the discipline that requires you to take that trade each and every time it pops up. And that discipline is a very key. And so you say lack of discipline. And I do it by time. There's certain times of the day I look at the market, certain times of the week I look at the market, certain times of the month I look at the market. But I do the discipline by time.
Tom, I had a great, speaking of time, mine is up, unfortunately. I hope you come back, though. I had a great time.
Hey, I enjoyed talking to you because this is something you got to have passion about. And, two things. You got to have the passion to want to do it. And the second, you got to have dollars to, get you involved.
Thanks, Tom. Well, if you've got a question about finance or a comment about the show, we want to hear from you. Make it pithy and concise and write us at Andre@WallStreetWrapUp.info. Now for a look ahead of market information for next week. But first, what broadcasting company was established on this day in 1969? We've got that answer in a moment. Well, what broadcasting company was established on this day in 1969? The Public Broadcasting Service, known as PBS. Well, if you've been watching the show, you've heard me talk about I-bonds or inflation bonds, and if you bought before October 31st, they were paying a yield of 9.6%, but they adjust every 6 months, on April 1st and on November the 1st. Well, starting this week, the new interest rate for the next 6 months for I-bonds will be paying 6.89%. Now, these I-bonds are sold directly through the Treasury Department and not so through banks. Now, there's also a limit as to how much these bonds you can purchase. You can buy up to $10,000 per individual in a calendar year, plus an additional $5,000 if it's from a tax refund. So in September, the S&P 500 was down 9.3%, which was, as you can see from our chart, which we had shown, it was one of the worst in almost 50 years. But we told you normally after a bad September, the S&P rises, with the only time, as you can see, in 2008, and that was due to the real estate crisis and the bank failures. Well, now that October's over, how did we do? Well, it turns out we were right. For October, the S&P 500 ended up just over 5.8% for the last month. So the next question should be, well, how does the rest of the year look, especially now that we're in November? Well, I've got some good news for you. According to the Stock Traders Almanac, since 1950, starting in November, the average move is in the up position of 0.9% starting in November for the next 3 months. Now, will stocks be going to continue to rise, or, as we've discussed previously, going up for a while and then maybe going back down once the Fed either raises rates or a recession hits the country? Only time will tell. But coming up next week, we'll be talking with Bill George. Now, Bill's a professor at Harvard Business School. He's also written a great new book called The True North's Emerging Leadership Edition. As a professor at Harvard, he also teaches business ethics, and he's also merges ethics with the leadership principles in this great book. The next week, Harvard Business School professor Bill George. Well, as a reminder, we repeat the show on Sunday mornings. Best way, though, set your DVR so you'll never miss an episode. That's our show for this Friday, November the 4th, 2022. I hope you enjoyed it. My thanks so much to Tom Busby for joining us this evening. But always, it's you. We appreciate you for allowing us into your homes tonight. So remember, follow us on all the social media on Facebook, YouTube, Twitter, and WYES.org. So enjoy your weekend ahead. Have a productive week as well. I'll see you next week. And remember, if it's Friday, it's Wall Street Wrap Up. I'm Andre Laborde. Remember, money never sleeps. Good night.
Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.